So a few slides first to illustrate how the pandemic, the shock of the pandemic, has affected the world economy. The shock has been often mentioned, but it's very, very dramatic. You see the fall in global activity at the world level. You see that the world GDP has contracted, which is something that never happened during the preceding decades. A contraction of the world economy never happened before. It happened this time, end of quarter 2, sharp contraction of the world economy. What makes it even worse is that there is a rebound. But if you look at the IMF forecasts, what the IMF was forecasting a few months ago for 2021 is a rebound, but still, and on average, 2021 for the world economy is going to be well below where it was expected to be slightly more than a year ago. You see that the gap between the trend and where the IMF expects the world economy to be on average during this year, it's close to 6%. A huge gap, a shock that will have lasting impact on the world economy, on the level of activity. Now, how are we now as far as the rebound is concerned? So here you have still at the global level, industrial production, and you see that there has been a sharp rebound. Trade, industrial production have been depressed. They rebounded in tandem. And if you look at this area by area, or even country by country, you see that the profile is about the same everywhere, more or less of a rebound, but the profile is still the same almost everywhere, except on the right-hand side, we have China and Taiwan. And you see that for those Asian countries, those two Asian countries, the dip was much, much more moderate. And you see that those two countries are now, as far as industrial production is concerned at least, very much back on trend. They are the exception. There was a first hit. China was the first hit by the pandemic, and China is now almost back on trend as far as industrial production is concerned. So much for the global picture. Now, a few words and slides on what's going on in China. China is learning, that's the title of this part, to rely on its own strengths. They had no choice, by the way, because the US has been really making things much harder for China. So they are starting to rely on their own strengths much more than they did before. You see what happened to GDP, the sharp fall, the contraction, the rebound. And if you look at the various components of activity, you see that part of the rebound is to be explained, if you look at the blue lines above on the right-hand side, by a sharp pickup in construction. Real estate investment has been one of the drivers of the rebound. We'll see this, we'll see why, and we'll see it again also in the US. And now if you look on the lower boxes, in the lower box in the middle, you see that activity in some sectors, and it's not surprising, you see that for hotels and restaurants, transportation, retail, activity is still depressed compared to where it was a year ago. So a shock specifically affecting some service sectors. This is something we'll find in all places. Even in China, it's still, it's a lasting shock. Now, if you look closely, a bit closer at the labor market, you see the hit on the Chinese labor market was visible, even with Chinese statistics on unemployment, a sharp increase in unemployment, and now unemployment is almost back to where it was a year ago. If you look at retail sales, you see that they are not totally back on trend. Car sales are also stopped increasing. And if you look on the right-hand side, you see that consumption, even in China, household consumption is depressed, much more depressed than disposable income, which means as a consequence that saving in China also, you know, household saving have been jumping. And this is also a common feature of the present shock. Now, still, the economy picked up quickly, mainly because investment rebounded very quickly, especially you see the green bars in this chart in the real estate sector. Not only, but the real estate sector, you know, has now a growth that is almost back on its former trend. and that provided a sharp, was an engine of the rebound. Now, how come real estate picked up so much? Because credit picked up quite a lot. What you have here is total credit to the Chinese agents, both local governments and private households and firms. You see that there has been a sharp increase in the debt to GDP ratio for the non-financial private sector, and that includes both firms and households. So credit helped boost demand for construction, and construction drove GDP and activity higher and cushioned the fall in activity. Now, on top of this, you had a huge deepening of the public deficit, what you see right here, a sharp increase in the public deficit altogether. This helped, bring back GDP. We believe at the end of the last quarter of last year, Chinese activity was back on trend, and we expect it, to remain on its trend this year because they are doing whatever is needed to get there. And this implies that this year's growth, 2021 growth in China, after 2% last year, we expect something close to 10% this year. It's big numbers, but remember, part of this is just a rebound from very low levels. And just one additional point I would like to make, Chinese authorities know that the rebound in activity was obtained thanks to a lot of borrowing. They're already busy trying to curb borrowing in order to avoid it from becoming too excessive. So they're starting to curb lending for real estate developers in particular, just in order to try not to be excessively excessive. They know there is an excess of credit, but they don't want it to be too much of an excess. So much for China. Now we move to the US, and here the title is also telling, we believe, uncertainties have dissipated, but many, many uncertainties still remain. Now, what happened in the US looks very much similar, but in worse than what happened in China. Here again, the impact of the shock of the pandemic. And if you look, you see that we are far at the end of the third quarter, we're still well below where we were a year ago. And if you look at what components of demand have been driving activity, you see that exactly like in China, residential investment in the US has been boosting activity above. I mean, in that sector, activity is above where it was a year ago, thanks here again to borrowing by households. And this is explained by the very low level of mortgage rates. We will say a word about it later. So residential investment is well above where it was a year ago. On the other hand, consumption is below. If you look now at an investment by firms, you see that equipment by firms has not recovered fully. It's not very depressed, but it hasn't recovered fully. And if you look at what explains this level of equipment spending in the US, it's detailed on the right-hand side, the box here in the middle. You see that there has been a sharp pickup. It's not astonishing, by the way, in info processing investments. That's 1/3 of total equipment investment in the US. But thanks to all the things you know about working at home and so on, info processing investment has boomed. On the other hand, transportation equipment and even some parts of industrial equipment have remained rather depressed. But the fall of equipment investment in the US was real. On the other hand, investment in research and development, that's a light blue line on the left-hand side on the lower box here on page 13. This has cushioned also the fall in investment. The effort of research and development has not been curbed by the pandemic. It remained slightly positive. So much for the various components. Now, what happened? We try to summarize this in a nutshell by looking at spending. The shock, was all borne by households. And if you try to detail household spending by income levels, this is what does the chart that is on the left-hand side. You can split using the real-time indicators, the so-called spending trackers that are available right now. you can split consumption between low-income earners, low-income households, and higher-income households. And you see the very peculiar features of this shock. Low-income household spending has been affected. It dropped sharply at the beginning of the pandemic, but for the last months, it has been almost back on its former level. What is still depressing consumption spending in the US is spending by high-income workers. Their spending is depressed. And when you look at the various components of spending that are depressed, you see it's the other charts, you see the service components, accommodation, recreation, transportation, food services. Those are all services that higher income earners do spend money on much more than low income earners. So that's a shock. The fact that high income earners spend less is affecting those spending in those specific service sectors. And the terrible part of this shock is that if you look at who is working in the sectors that have been affected by the pandemic, and this is what we detail here on the charts on the right-hand side, here we accumulate the losses in employment by sector. So when you move to the right, you accumulate the different sectors, the losses of employment in the different sectors. So you see that food services, for instance, explains close to 7 million job losses at the end of the first quarter in April, a sharp fall here at the worst part of the pandemic. If you add losses, employment losses in the retail sector, you get close to 10 million, and so far when you move to the right, okay? Now, what do you note? In the pink part of the chart, you have close to 20 million job losses, and they are all concentrated. The pink part corresponds to the sectors in which our earnings are the lowest in the US economy. So that's the fact that the higher income earners in the US spent less has been affected those who earn less in the US and not homogeneously all the population. So the loss of jobs has been concentrated in the low income part of the US economy because it's all those service sectors that have been affected by the pandemic. That's a very specific, I repeat, nature of this shock. Now, if you move one step further, what did the government do? The US government, and most governments actually did exactly what they were expected to do in such a situation. They've been borrowing the spending, the part of their income that the wealthiest household didn't spend. They've been borrowing it in order to lend it to those who are losing their jobs. And this happened to a huge extent in the US. Those are the transfers. And if you just look at the lower box on slide 15, you see how income formation has been affected by the pandemic. On the left-hand side, you have the contribution of wages. Wages, because of huge employment losses, wages have been decreasing between the first and the second quarter, but transfers have been huge. Households have been getting checks, unemployment benefits have been extended, have been increased, extended to non-wage earners, increased for everybody. So a huge amount of transfers, which meant that despite the fact that unemployment increased, that wage income shrank, total income household has been increasing right after the pandemic. Now, if you also take into account the fact that consumption has been falling because there has been less spending, I'm afraid somebody has opened its mic. If you look at the net saving of households, you see that net saving of households jumped right after the shock of the pandemic. And if you look at how things moved from here on, you see that saving by household jumped by close to 20% of GDP points and then shrinked a bit during the third quarter. At the same time, the government deficit jumped by close to 20% of GDP, which means that all in all, more or less, the government has been borrowing the increase in saving by households in order to finance the transfers it made to those who have been losing their jobs. And we believe that this has been a huge help to stabilize the economy. Now, from here on, what is going on? Well, investment has been resisting. You see that if you look now at the last available indicators, shipments of capital goods have jumped, so did new orders, and it means that equipment investment is picking up. And one explanation is that in the US, the government has been generous not only with the unemployed, but also with the small firms that have been affected directly by this pandemic, because restaurants, hotels, and so on are mainly smaller firms, not big corporations. And the so-called Paycheck Protection Program has been devised in order to make loans to small firms, but transform those loans into grants if the small firms that were receiving those loans were keeping their employees. And part of the loss of income of those firms have been compensated by this transformation into grants from the loans that had been extended to them. That's a peculiar aspect of the Paycheck Protection Program. And this, we believe, is helping smaller firms in the US, not perfectly, of course. Nothing has been perfect during this crisis, but still, it has been a helpful component of the support the government has been giving to smaller firms in the US. I'll come back to this in a minute. Now, this is all the things that were done when the shock happened and to help the unemployed and the small firms to absorb the shock. Since October, unfortunately, since the end of the third quarter, things got worse. You know that the pandemic everywhere, has been picking up again. If you just look at occupation of hospital beds in the US, the lower chart, the green line, you see that it's now exactly double from what it was at the beginning of the pandemic in March, or in July, a huge doubling of hospital bed occupancy. That just tells you that things are significantly worse. And the second observation you should have in mind is that at the beginning of the pandemic, what you see here is a distribution of cases across the US by regions. The different colors correspond to the different regions you have above. And you see that during this phase of the pandemic, you have cases everywhere in the US, while at the very beginning, they were concentrated just in the few parts of the US. So a much more intense pandemic all over the US. So the shock is much more homogeneous now. Now, how come we dare to be rather optimistic on the economy? Because, as you've heard, vaccination is, we believe, something that should hopefully allow social distanciation, to diminish significantly by the end of this year. So the bet we're making in our scenarios, this is what you see right here, is that despite the fact that we are still below the trend at the end of 2020, we believe, we can get back on trend, more or less. It's not going to be a straight line, but still it's something that is rather possible. And that's the bet we make in our so-called central scenario. That would imply growth in the US economy close to 5% in 2021 compared to minus 3% during 2020. Now, second thing, for this to happen, you'll have to take care of the fact that we still leave 2020 with 10 million jobs missing in the US economy. So for our central scenario to take place the way we assume, you have also to account for the fact that you have those 10 million people who have no income right now. And the good news is that those people were about, you may have read it, to lose all the unemployment benefits they had gotten. At the very end of December, Congress voted an additional, the so-called COVID relief bill, that extended for 3 months most of the support that was provided by the so-called CARES Act. So the good news for our scenario is that in December, at least until March, there has been an extension of the support measures thanks to the COVID relief bill. That's one thing that makes our scenario a bit more likely with vaccination, as I've said. But still, remember that end of March, this is what you have here as an illustration. I don't know if it's very clear for all of you, but still the idea is that if there is no additional support after the relief bill expires, most of it expires in March, there will be a so-called fiscal cliff. So there could be a lack of support because you won't have solved all the unemployment issues and so on. So one of the preconditions for our scenario to unfold smoothly is to have some additional support to the unemployed and to the state and local governments who also are missing a lot of money. Now, second problem, and that's also very important, for the scenario we have in mind to unfold for the unemployment rate to get back to much lower levels, you need to also compensate for the fact that you may have some lasting changes in the way consumers spend, not on how much they spend, but on what they spend their money on and how they do their buying. You know that if you use internet to buy instead of going to brick and mortar places, well, it creates less jobs, it destroys jobs. But if you also, what we try to show here is what happens if instead of buying services, you buy goods. You spend the same amount, but what we assumed is that you spend 10% less on the services that have been affected by the pandemic. That is, you kind of diminish a bit the usage you make of restaurants, of hotels, of airplanes, of transportation, and so on. You don't, just because you remember that you didn't do it during the pandemic and you forget to do it again as much as you did before. 10% less spending on the services that were affected by the pandemic, and we redistribute all this spending on goods, food and beverage, and other goods, so that the total spending on consumption is the same, zero change, but less on services and more on goods. Well, the result is that you lose 1 million jobs in the US economy. So you also have to compensate, we believe, for this loss of jobs that will be related not to the fact that there is less consumption, but that there is a change in the consumption patterns. It's one thing that is also plausible. So we believe, and this is not just because we tend more to be on the Democrat side than on the Republican side, at least I'm talking for me, for myself, but, and Florence, I think, has the same bias. But the program of Joe Biden tries to provide some assurances on the two conditions I've been mentioning. First, Joe Biden wants to extend the provision of the relief bill that has just been passed. He wants to extend more support to the local governments and more support to the state and local governments, and also more support to the unemployed. As long as they will be unemployed, they will get additional benefits and so on. And in the longer run, he wants to invest to make the US greener and more digital. He wants to rebuild a middle class in the US. He has a program called Build Back Better, infrastructures, education, and so on. And this will, we believe, create, everything being equal, it will help create more jobs in an economy in which you need to be able to absorb some people who are lacking many skills, but who need to find a job, because this is a consequence of the pandemic. It's affecting people who are rather low skilled and who will have difficulties finding jobs. And that's precisely where his program, we believe, fits very nicely in the present situation of the US economy. And this program, we believe, will not pass, in its integrity, but there is a good chance that parts of it, especially with the fact that he has a relative control of the Senate now, you have a good chance that this program will pass. Now, just to conclude, what is happening is that the Fed, has been helping heavily the government to finance this deficit, this, and as a counterpart, it kept rates very low, and at the same time, it's been buying the bonds the government has been issuing, and the counterpart of this bond buying is to be found in the saving of households. And if you just look at what has been happening in the household balance sheet, you have had a huge increase in household deposits. Households have never seen such an increase in their balance sheet take place under the form of deposits. And this, of course, if you just think of it in terms of portfolio rebalancing, implies that this is going to be an upward pressure combined with the low interest rates. This is an upward pressure on all assets that have some return or some capital gains, offer some capital gain perspectives. And this, we believe, is weighing on the prices of both equity, homes, and Bitcoin, and whatever, you name it. But you have this huge amount of liquidity under the form of deposits that has to find a way for a rebalancing to take place. And we believe that this will push the Fed to let rates go, long-term rates, go up to provide some income to those who hold bonds, while at the same time being very careful not to let bond rates move up too quickly, because that would very much affect real estate investment and, of course, the financing of the deficit. So the Fed is now walking on a tightrope between financial stability and the need to keep providing support both to the US government and to the US economy through the mortgage rate, by keeping the mortgage rate low. So much for the US economy. And now I give the floor, if I may say so, to Florence. Florence?
Yes, I will just try to share my screen.
I hope you can do it. Yeah, I'm starting to see you.
Yes, it should work. Yep.
Florence?
Yes, do you see my screen?
No, I'm not, but yes, I do.
Okay.
Can you make it bigger?
I'll make it bigger, yeah, in a minute. Okay, here we go.
Is the screen okay for everybody? Yeah, it seems to be okay, Florence.
Okay, it seems to be okay. So we move now to the euro area. And what you have here is just euro area GDP. So what happened, as you know, is a huge shock on GDP in the second quarter. But then you had also a huge rebound. And that is something that was, I think, underestimated by some people on the market. So if you look at GDP, it's just 4% below year-ago level, exactly as in the US at the end of the third quarter. That's for the good news. Now, the bad news, of course, is that this recovery has been pretty uneven. And you see here what happened. You see that at the end of the third quarter, Germany, France was 4% below year-ago level. The Netherlands, by the way, was doing much better, 2% below year-ago level. But if you look at Spain, you see that in Spain, GDP was still almost 10% below year-ago level. So a shock that has been that had much more impact on some economies than others. So now, if I take this one, if we look at employment, what happened on employment, what we have here is what happened first on GDP growth. So that's what I've just illustrated. The shock in Spain at the end of the second quarter was much deeper than in Germany. But it was not only about growth, it was also about employment. You see that employment in Spain has been declining by more than 8%, while it just barely declined by 1% in Germany. So labor, employment was much less preserved in Spain than in Germany. And if you compare Spain with other economies that also have undergone a deep shock in the second quarter, like Italy and France, you see that here again, employment was much more preserved in France or Italy compared to Spain. So a huge shock, particularly on Spain and particularly on employment in Spain. Now, it's not only about employment, it's also about disposable income. I think it's not a good presentation, I'm afraid. Just a minute. I made a mistake. Okay. Let me move again. This one. Okay, skip this one. Here we go. So if you look at the shock, not in terms of employment, but in terms of disposable income, you see that Spain has been much more impacted than other countries. You see that in the Netherlands, disposable income has been preserved, even growing slightly. And what you see also is that in Ireland, disposable income has been increasing. So it's not only about employment, because employment in Ireland has been declining. It's also about the response of governments. You had much more transfers to households in Ireland than in Spain. So a huge shock on the Spanish economy and much less government support, at least for households, which explains the gap between the disposable income in Spain, a sharp contraction, while in some areas it was preserved, and in some economies it even increased slightly, as you see on the right hand side. Now, the shock has also been disproportionately affecting low-income countries. You see here, low-income earners have been more impacted than high-income earners. This is, of course, not a surprise. And if you look in terms of ages or qualifications, you also see that the shock has been concentrated on younger people and less qualified people. And unfortunately, the share of those people, the people affected, younger people and less qualified people, has been much higher in Spain or Portugal, so in the southern part of Europe, than in other economies. Now, so far for the past, if we look at what happened in the third quarter, here again, I think it illustrates quite clearly what happened. Everybody, of course, activity rebounded, and you see in the case of France, the different sectors that were impacted at the end of the second quarter. You see that in many sectors, activity recovered, even if it was still affected in, for example, arts and entertainments, still 10% below year-ago level, but it was much better than at the end of the second quarter. Now, if you look at Spain, here again, you see that many sectors remain under heavy pressure at the end of the third quarter. So clearly, some economies are more impacted and some economies have had less capacity to rebound in the third quarter. Now, second thing that is important, if we look still further ahead, of course, as you know, the epidemic is far from being under control. And what you have here is just hospitals or intensive care units, beds occupied. And you see that in some economies, and you see in particular what's happening now in Germany, intensive care units are under pressure. You have more and more people in intensive care units. And of course, this has forced governments to take new measures in terms of restrictive measure on activity. So what we believe is that this is going to curb activity. And if you want to look at real-time data, you have a lot of mobility data. You see here Google mobility data, and you see the deterioration of mobility since beginning of October. Remember that in November we had new lockdown in many euro area countries, and you see the new deterioration in January with a sharp fall again in those mobility data. Now the consequence is that activity is going to falter again in Europe. That being said, I think we have to be cautious, not to be over pessimistic by using just those mobility data. Remember that governments have drawn some lessons from the first lockdown. During the second lockdown in November, construction sector, but also the manufacturing sector was still operating, which was not the case in the first lockdown. And also many people adapted. Remember that in many places we have developed click and collect solutions. So here again, we believe that the impact on activity is going to be milder than during the first lockdown. But of course, it's going to curb activity at the end of this year, at the end of last year and beginning of this year. So our central scenario, you see what we do expect. We expect a contraction in the fourth quarter of 10% at an annual rate, and then no recovery in the first quarter, and a recovery from the second quarter on, assuming, as in the US, that vaccination, there is mass vaccination, and we don't have a lot of logistic, or we manage to deal with the logistical issues of mass vaccination. This is part, of course, of our central scenario. We believe that what we put in this scenario is that governments are able to mass vaccinate their population, so that herd immunity by the end of the year is reached and activity is back to normal. Now, this could sound as an optimistic scenario, of course, but even, and that's what I want to insist on, is that even in this optimistic scenario, where GDP is almost back to normal by end of 2021, there are going to be some legacies. There's going to be some legacy on many European countries. So the first thing is that we don't believe that employment will be back to normal by end of 2021. We do believe that some sectors will. And I'll come back to that. Then unemployment will not be back where it was at the end of 2021, even if GDP is back on trend. Second thing that is important is that some southern economies are going to be much more impacted than others, and they will not be back on trend. Just to illustrate this, what we did is that, as in the US, as you know, there could be some changes in the household behavior. Anton illustrated that for the US. But if you look at the effect on demand of protracted social distancing, you see that for Greece, for example, the impact on growth is going to be much higher, because those sectors, restaurants, recreational, package holidays, are weighing much more in consumption than, for example, in Belgium and the Netherlands. So if you just take the case of Greece, you see that 20% of consumption is concentrated in heavily impacted sectors by social distancing. So if you believe that by the end of the year, there will still be those sectors will not be back to normal, the impact is going to be twice as much in Greece than in Italy, and twice as much in Italy than in Belgium or the Netherlands. So clearly some southern economies are going to be heavily impacted. Now, second thing that is important is that in southern countries, remember that the share of small companies, and you have here the small companies, the share of small companies is much higher, especially for the share of employment by small companies is much higher than in northern economies. You see, for example, in Italy, Portugal, Greece, small companies are hiring 60% of total employment, while the share is just 40% in many other economies in Europe. Now, if you look at just the hotel and restaurant sector, you see that the share of employment in Greece is more than 20%. It's just 3 or 4% in France, 6% in the Netherlands or Germany. So an impressive share of hotel and restaurants in employment, which means that employment will be far from back to normal, we believe, in southern economy, especially Greece, but also Italy or Spain. And the last thing that is important is that if you look at the impacted workers, the sectors that have been most affected are employing a huge share of less educated workers. And just to illustrate this, the impacted sector represents 30% of GDP, but as you see here, they represent almost 50% of less educated employment. So clearly a shock that is going to disproportionately affect less educated people. And of course, it means that governments will have to retrain those people to enable them to find a new job. And this, of course, is going to take more time. Now, here again, just to illustrate the same thing, if you look at the share of less educated people in total employment, you see that it's way higher in southern part of Europe than in the northern part of Europe. So here again, a shock disproportionately affecting southern economies. Last thing that is important is what happened on investments. What you have here is the contraction of operating losses for non-financial corporates. And you see that the contraction has been quite important, -8% in Spain. But you see that in the Netherlands, you also see a sharp contraction of operating income in 2020. Now, this is before subsidies. If you look at all the government subsidies that have been given to companies, you see that there has been stronger support in some countries like the Netherlands or Austria. And this, of course, we believe is very important because it could prevent investment to continue to falter, which is not the case in Spain. So what we did here is compare the situation in Germany and Spain. And what you have here is the operating income, the loss of operating income in Germany. If you compare the loss of operating income to 2019 investment level of those companies, for Germany, the loss of operating income is 13% of gross investment. Now, if you look at Spain, it's 36% of gross investment. So a shock on operating income that is 3 times bigger in Spain than in Germany. And this, we believe, is going, of course, to delay further the recovery on investment in Spain. And this could also have an impact on the future potential rate of growth in Spain compared to other economies. So the consequence of all what I've described is that what we believe is that divergences in Europe are likely to continue to grow. What you have here is GDP per capita compared to the German GDP per capita. So it's a comparison of the level of GDP per capita compared to Germany. And you see that divergences have been starting a couple of years ago. Since 2000, for example, French GDP has been growing much less. GDP per capita has been growing much less rapidly than in Germany. And if you look at Italy, of course, it's even worse. On the right-hand side, you see that for Spain, the GDP per capita in Spain, before the crisis, was 70% of the German GDP per capita. So what we believe is that this crisis is going to increase divergences in Europe and leave here again some legacy, more legacy than the previous crisis. Now, of course, the good news is what has been decided at the European level. As you know, we put in place a so-called Next Generation EU program. It has been accepted at the EU level. Now, governments will have to ratify this. Parliaments will have to ratify this at the national level. But this is good news, and this is exactly what we should do. So Next Generation EU is a program where you have almost 390 billion of grants, and those grants will benefit more. You have here on the left-hand side, they will benefit more countries that have been most impacted by the crisis. Italy and Spain will receive 4 to 5% of their GDP, and Portugal and Greece are supposed to receive 7 to 9% of their GDP over the coming years. So it's exactly what we should do, more solidarity within Europe, especially to economies that have been much more impacted than others. Now, the issue with the program, of course, is the implementation and the details of the implementation. What we know is that you have a lot of governments that are weak governments. We know what's happening now in Italy. We don't know if there might be some new election in Italy in the coming months. If you look at Spain, the government has responded very weakly compared to other governments. The government has been pretty weak also. So all the issue with Next Generation EU is the implementation. If governments are not able to propose projects to the EU, then of course they will not receive the grants. So for this program to be implemented, we believe that there should be some efforts coming from the countries, and the countries should be able to present a viable project to the EU for this project to be approved and the money to be granted. So implementation is important. And the last thing I want to insist on is the legacy in terms of public debt that this crisis is going to leave. So what you have here on the left-hand side is net lending and borrowing. And you see that the counterpart, of course, of higher public debt is more saving accumulated by households. Now, if you look at what is going to happen, even in our central scenario, where we are back to trend by end of 2021, you see that in our scenario, debt to GDP is going to increase by 1.3 trillion over 2020-2021. And if you are more cautious about the growth trajectory in Europe, you see that the accumulation of debt is going to be 1.6 trillion over 2020-21, and even 2.1 trillion until 2022. So clearly debt is going to increase, public debt is going to increase in the coming years. Now the ECB is going to facilitate the mobilization of household saving in order to absorb government debts. And as you know, the ECB has a so-called bond buying program that is called Pandemic Emergency Bond Buying Program. And if you look at what the ECB is going to buy, so governments are going to issue more bonds, but the ECB is going to buy so much that net issuances after ECB bond buying is still going to be negative in all places. It's hugely negative in Germany, but it's still negative for Italy, France, and Spain. So clearly we think that for this year, there is no issue about being able to absorb the huge bond issuances thanks to the ECB. So the ECB is going to prevent long-term rates to jump, we believe, in Europe. Now, that being said, what we believe is that if we look a bit forward, we might be forced to go towards more fiscal solidarity in Europe. And that's the last slide, just to illustrate this. So what we did, and I will comment Germany and show you after that other economies. So what you have here is a trend real GDP in Germany before the crisis. You have also the primary budget balance. So you see that Germany had a primary surplus of around 2 GDP points before the crisis, and it was projected to be stable afterwards. And so you have the debt trajectory. Germany was slightly below 60% before the crisis, and the debt to GDP was projected to fall below 40% by mid-2025. Now, of course, we had a huge shock on the German economy. So the primary surplus has turned into a primary deficit. And we believe that Germany will be able to rebalance, but it will take some more years. So that the debt trajectory here in this scenario is a bit less favorable, but still it's not awful. Germany should be able to bring back debt below 60% by mid-2025. Now, we could not exclude a more negative scenario where the potential growth is durably impacted because of bankruptcies and because of changes in household behavior, which means that it gets longer to be back on potential, and slowly, because firms do not invest, potential investment is impacted. Now, in that case, it will take longer to rebalance the primary budget, and you see that the growth trajectory is slightly less favorable for Germany. But of course, Germany is a rather favorable example. Now, if you look at the same kind of scenarios for other countries like France, Italy, or Spain, you see here that the debt trajectory at best, debt will be 20%, 20 GDP points higher. And the risk, of course, is a red scenario where we are not able to stabilize debt to GDP ratio if the potential rate of growth is impacted. So the conclusion of this, it was just an exercise, of course, but the conclusion is that we might be forced to go towards more fiscal solidarity. And here, of course, it will be very important to follow what will happen to the next election, we believe, especially in Germany, but also in France in 2022. Now there are coming elections in Germany, and we believe that we will know more about the next chancellor after maybe the end of the week, because as you know, new leader of CDU is going to be designed. There are 3 candidates, and 2 of them are on the same line as Merkel, but one of them is much more conservative, and it will mean much less deeper integration in Europe going ahead. So I think this is, of course, something that should be followed in the coming months. So I hope it was not too long, Anton. And maybe, yes. I'm sure there are a lot of questions.
At least there are some questions, Florence.
Yes.
I may start because I had the opportunity to look at some of the questions where you look at them also. Okay, do you hear us? Yeah.
Yes, Anton.
Okay.
Yeah.
First question, China data is famous for being unreliable. Can we trust the data? Well, we have no choice. So we do trust the data to some extent, just to make the answer very simple and quick. But we agree with the person who raised the question. There is a problem of reliability, but we have no choice. So we believe that it's more or less a reflection of what's going on. Florence?
Yes.
Is GDP growth are expected to grow? Have you had time to look at the questions?
Yes, I think there was a question about inflation as a thing. We are rather optimistic on growth, both in Europe and the US, but we don't believe that inflation will jump. Now, in the US, you have to be very careful. Remember that 30% of US CPI is rents. And if you look at what has happened right now, is that there are a lot of pressure on rents in the US. Many people are unable to pay their rents. So you might have some defaults. Rich people are owner, but if you look at rents, you have a lot of downward pressure, we believe, on rents, and rents are 30% of US CPI. So of course, you have some basis effect because of oil prices going up. You will see on a year-on-year basis a rise in inflation, but we don't believe that inflation will get out of control. And in Europe, it's even more obvious. We believe that the pressure on the labor market is very important. And there are no reason for inflation to jump. There are even reasons for inflation to stay pretty weak. Now you have base effect for oil in Europe. You also have some base effect because of the VAT. Germany cut the VAT until the end of last year. It stopped at the end of last year, so you will have a VAT rise, and this will add a couple of tenths to underlying inflation in Europe. But we don't believe it means that inflation is out of control. It's just a base effect. On average, inflation will be around 1% in Europe. That's our forecast for 2021. It was 0.2 last year, so it's creeping up, but 1% is still way below ECB targets.
Florence, one more word on, because the question was about GDP growth being very high, and don't we expect inflation to pick up because of the elevated rates of growth? The point we insist on is that don't be misled by the elevated rate of growth, because when we say 6% or 4 or 5%, it's compared to a very depressed level, and it just means that you're back on potential. You're not above potential. You're just back on potential with those rates. And as Florence said, we don't see any reason for inflation to pick up, at least during this year. Why is Austria so low in disposable income? Florence, do you have an answer?
No clue. Those are the official data. To be honest, I didn't look at Austria. I just look at Austria for the support to companies, and I know that they have been putting in place a lot of support, much more than in other economies, for companies, for business, small businesses. But I have no clue about disposable income, I'm afraid.
But we trust the data. Here again, it's like for China. Florence, je vous laisse la question sur le change. Je réponds sur how much productive growth can government spending create? And the question is, you can pay people to dig and fill holes. That's an old story. But that doesn't create an increase in productive growth. We totally agree. But what's happening right now, the issue is not productive. It's not growth and investing in productive growth. If the government is spending, it's just for solidarity's sake. You have people who lose their job because you're forbidden to go in restaurants. And the government is just trying to compensate for this and to offset this by spending on unemployment benefits in a way or another. And the government is borrowing to do so. Nobody pretends that it will increase productivity, but it will prevent too much inequalities in our society to increase, because the people who are suffering from this pandemic, at least as far as the economic aspect is concerned, are those who lose their jobs, and the government are just trying to compensate for this. We believe it's has nothing to do with productivity, and we fully agree. It doesn't increase productivity, but it improves the well-being of those who are losing their job for reasons that has nothing to do with it.
Euro dollar, we see the dollar going slightly higher. The dollar, as you know, has weakened against the euro of the last months. We do believe the dollar should appreciate a bit against the euro, and the reason is that you have first much more stimulus in the US. The second thing is that if you look at the timing, the US has started vaccination before, 6 weeks before Europe, so they will reach herd immunity with quotes before Europe. End of Q2 is something that is possible for the US, while we will have to wait until end of Q3 in Europe. And the last thing is that we do believe that there are more risks on the recovery in Europe than in the US because of the fiscal package, which is possible, but also because of the divergences within Euro area countries. So altogether, we do believe that the strength, relative strength of the US, the rebound in the US compared to the Eurozone, we should see a slightly higher dollar and weaker euro.
Well, there is a question on stock markets. Are they overbought? Is a bubble building and so on? Well, for the reasons we've been mentioning, we believe, we wouldn't say they are overbought, but there has been a lot of buying going on, and it's very logical. People have been saving. I mean, those who kept their jobs couldn't spend. And those are high-income people, mainly. And part of the savings they have, you know, goes, somebody mentioned buying Tesla stocks. That's part of the solution, of course. But you can buy anything, you know, any investable asset can be bought. I mentioned Bitcoins, but you can have cars, collection cars and so on, vintage cars, anything, you know, you can invest on, diversifies your portfolio in order to prevent it from being excessively invested in deposits, especially in the zero income environment. So there is some, stock markets are expensive. We don't believe, Florence, correct me if I'm wrong, we don't believe we are in a dangerously vulnerable bubble territory. Do you agree, Florence?
Yes. If you look at valuation and compare, for example, with 2000, it's completely different because you have to distinguish. This time, the shock was concentrated on companies that were not quoted. So if you look at profits of quoted companies in the US, they have been recovering after a shock, of course, at the beginning of last year, but they have been recovering pretty nicely. So if you look at PE, yes, they are expensive, but it's nothing comparable to 2000s. If you look at the rate of growth, in particular of medium-term earnings by analysts, in the 2000s, those rate of growth were crazy. People were expecting 20-25% of annual rate of growth of profits over the medium term. This is not at all the case now. When you look at consensus estimates of medium-term profit growth, they are much more reasonable. It doesn't mean that some stocks are not overvalued, but on average, it's more reasonable than at the end of 2000, that at the beginning of 2000.
There is a last question, Florence. I don't know if you have an answer on insurance companies. The question is not totally clear, but are they sufficiently strong?
To be honest, I don't know. I didn't look carefully enough to find.
We believe most banks are strong. We're not as sure about insurance companies. We didn't have a very, very intensive look.
And then you have to be very careful because you have to look at a country on a country by country basis, because some companies have guaranteed rates, they have guaranteed returns that they are that they are going not to be able to pay, but it's not the case in all European countries.
I think we're run out of questions. Oh no, Europe has done everything and failed to create inflation for 5 years. Why are they going to succeed now? We're not sure we'll succeed.
No, we believe that inflation will be low for another while. So we are more on the side of it's going to be difficult to pull up inflation for inflation to pick up. So it moved from 0 to 1, but 1% is still way below ECB target, and bringing inflation back to 2 or slightly above 2 is going to take time.